welcome to Trade Phantoms Foundations of Trading, Lesson 3. I'm Mr. Black, and in today's lesson, we are going to be talking about risk management, position sizing, and trade management. Risk management is one of the most important aspects of trading, and it is often one that is overlooked by retail traders because they don't really understand just how important and significant it is. In trading, a lot of times when people think of professional traders, they think that we have a much better sense of winning trades than losing trades, and that's very true. Of course, we're analyzing the highest probability trades we can, but ultimately, no matter how good a trader and analyst you are, you're never going to be right 100% of the time. The reason for this is trading at its heart is simply probability analysis. What does that mean? That means that professional traders are not perfect. BlackRock loses trades. State Street loses trades. UBS loses trades. Literally, the largest investment firms in the world, the ones who control trillions of dollars in assets under management, lose trades every single day. And what that means is no matter how good a trader you are, no matter how much time you put in, no matter how much effort you put into analyzing a chart, even if you do everything perfectly right, you make zero mistakes, dot every I, cross every T, you're still going to lose trades because trading is simply probability analysis. The best we can do as traders is to determine whether a trade is a high probability trade or a low probability trade. It is never a guarantee. So professionals accept this fact. We understand that with any trade, no matter how beautiful the trade setup is, there is always a margin of error. And what we do is we look for the highest probability trades, but we look for high probability trades and take it a step further and say, of these high probability trades, which ones have the lowest risk with the highest proportion of profit targets? So, like as many of you know, we have a 20-point scoring system here at Trade Phantoms that's proprietary to the way we analyze the market. Even if a trade has multiple time frame correlation, beautiful structure, nice 20 out of 20 score, it's still not a guarantee. It's just a higher probability. If you want to think about this in real world terms, think of it from this perspective. Imagine I have two basketball players. One is at the 3-point line, and one is right underneath the basket shooting layups. And they both have to shoot 20 shots. Which of those two players is more likely to score more shots, to have a higher degree of their shots go into the basket? It's going to be player B, right? Player B is under the basket, and a layup is a much higher probability shot. Even if you were Steph Curry and you were having to choose, if his money was on the line, he would choose player B over player A, even if he himself was shooting. And that's a good summary of what trading is like. Trading at its heart is just probability analysis. We can skew the odds in our favor by selecting the higher probability trades, right? We can select the, so to speak, layups of trading. But just because we're selecting higher probability trades, that doesn't mean every trade is going to be a winner, right? Just because player B is shooting layups, that doesn't mean every single shot that player B shoots goes into the basket. And this really speaks to the heart of trading. Trading is all about risk management. So there's a few things you need to take into consideration if you're going to get involved in trading. First, you need to understand that you are 100% in control of your risk. A lot of people don't understand that about trading. But in reality, you control your entire risk in the market and you determine what risk you are willing to take on. So one of the first things you need to do as a trader is you need to determine for yourself your own personal maximum acceptable loss. This is a number where you say, if I lose this amount on a trade, I'm okay with it. I've scraped my knuckles. I'm not out of the game. So this is a number that should not affect you emotionally, and it is a number that you determine for yourself. That number is going to be your risk management number and your stop loss. It is the most exposure you will ever take on a trade. So when professional traders are taking trades, before we ever enter the trade, we are determining our stop loss, in other words, our risk in the market, and we are determining our profit target or profit targets if we have more than one. This is called a bracket order. When you place trades where you have boundaries both in terms of risk as well as in terms of profit target, that is called a bracket order. So first, you need to determine for yourself, what is my own personal maximum acceptable loss? And you control that number. When I first started trading Forex many, many decades ago, I would risk $1 to make $3 or more. And this was not a lack of equity. I had more capital to put into the market. The reason I started with such a small amount of capital was because I didn't want to get emotional about the trades I was taking. I wanted to reduce my risk exposure and really focus on the process rather than letting my emotions affect my decisions. And in that scenario, if I lost a buck, did I really care? It was a dollar. It wasn't going to affect my life one way or the other. On the other hand of that, if I won $3, was I over the moon? No, it was $3. It still wasn't affecting my life very significantly one way or the other. So it really allowed me to focus on the process and establishing consistency rather than on the money itself. So let's talk about bracket orders. So bracket orders have three parts. First, you have your entry price. Now, there are two types of orders you can place in the market. We talked a little bit about this in terminology. You can place market orders and you can place limit orders. Market orders are about speed of execution. It's get me in as quickly as possible. I will pay whatever the current market price is. Limit orders are about specific price points in terms of entry. I'm only willing to buy or sell this asset at this very specific price or better. I'm not willing to pay any price. This is a very key distinction in terms of entry for trades because retail traders, for the most part, place market orders. Retail traders are very reactionary to price action, and when they see price moving, they try and chase that price movement after it's already occurring and cross their fingers that they'll be able to continue with that same movement. Banks, hedge funds, professional traders almost exclusively place limit orders. For the most part, we are never chasing price. We identify key levels of entry where we want to buy and where we want to sell. And if price comes to those levels, we look for an entry. So we are not chasing price. We are not willing to pay any price. We have specific price points where we want to buy and where we want to sell in the market. So that is our entry. That's the E of our bracket order. You also need to determine your risk management. So as we said, you're going to determine your personal maximum acceptable loss. But that's not necessarily what the calculated stop loss will be on the chart. So a stop loss is a protective order where if the trade moves against you, as soon as it hits that number, the trade will automatically close for whatever that number you've determined is. Now, sometimes you may find trades where the calculated stop loss, or in other words, the calculated risk on the trade, is more than you personally are comfortable taking. And if that is the case, with discipline and following proper risk management, you should not take that trade, no matter how pretty the setup is. So let me give you an example. Let's say you determine for yourself, Mr. Black, the most I'm willing to risk on a trade is $10. That is the most I'm comfortable with. Anything more than that, I will feel uncomfortable with that risk assessment. I'm not willing to take more risk on than that in an individual trade. It will make me nervous. It will make me stressed. Great. What if you find a trade where the calculated risk is just a little bit more? Instead of being $10, it's $12. But oh, this setup. Oh, it's such a good looking setup, Mr. Black. It looks so good. It has a great risk reward ratio of 5-1. So you're risking 12 to make $60. Beautiful. Scores a 19 out of 20 in the scoring system. Multiple time frame correlation. Has a beautiful breakaway gap. All of these factors that you like so much are all there. Trading with trend, etc. Should you take that trade? And this is one of the hardest things that new traders struggle with. You should not take that trade. If it does not fit within your risk management parameters, you shouldn't take the trade. This is oftentimes very difficult for new traders because they tend to over risk, over position, over leverage trades based on their emotions rather than based on structure. Trading is very, very structured. It is very process oriented. If you want to have consistent results as a trader, you need to be consistent in your approach to trading. This is one of the most critical aspects. So, general rules of thumb from professional traders. Most professional traders will never exceed more than 2% VAR. VAR stands for value at risk. In other words, the most they have exposed on any one individual trade is 2%. That's a general industry standard practice by most professional traders. A lot of them will do less than that. I personally do not exceed more than 0.5% VAR. And a lot of large investment firms typically do not exceed more than 0.1% VAR. So that gives you a real semblance of how professionals trade. Professionals expose little. Professionals risk very little. And what we do is we look for trades that have low risk with high profit targets. Ideally, reward to risk ratios of 3-1 or higher, where our profit target is 3 times our risk or more. If you trade in that manner, where you are selective about the trades you take, where you only take high quality trades that have low risk with high profit targets, you can actually be wrong 75% of the time and break even. And I'll show you a breakdown on that on a later slide. So, first you have your entry, and then you have your stop loss, your risk, the most risk you're going to take on the trade. The third thing you have is your T, your profit target. And this is where you're getting out of the trade for profit. This type of setup is called a bracket order. And what you're doing by placing an order in this manner is you're establishing boundaries around your trade. There are literally only two outcomes to the trade. Either A, you're going to be wrong on the trade, and it's going to move against you and hit your stop loss, but it's a number that you have determined you're okay losing, right? You understand that as a trader, you're not going to win every trade. So you're making sure that you're taking trades that fit within your risk management and limiting your risk exposure on those losing trades, making your losses small. Or B, it's going to hit your profit target and you're profitable. If those are your only two outcomes, this should help you in making decisions in a more timely manner. And that's oftentimes very important to trading. So trading is about risk management, discipline, never over leveraging, never over positioning, and making sure you're taking high quality trades that have low risk with high profit targets. If you trade in this manner, as I said before, you can be wrong 75% of the time and break even. So that means anything above a 25% win rate would actually be profitable. The other cool thing about bracket orders is you can set up these trades ahead of time and you do not need to sit there monitoring the trades. You've established boundaries around the trades. There are only two outcomes. Either it's going to hit A, your stop loss, or B, your profit target. You sitting there watching it will not affect the outcome. So you can literally set it and forget it. Go about your day, go do something else. And if you are a new trader, it is probably best if you do that, because that is when new traders tend to start messing around their trades after they are already in the trade. So you're going to be the least emotional before you enter the trade. So before we ever enter the trade, professional traders will calculate our entry, our profit target, and our stop loss. This is how we determine if a trade is worth taking. Now, as I said, if you win over 25% of your trades, practicing 3-to-1 reward to risk ratio and never exceeding 2% VAR, as long as you win above 25% of your trades, you're actually profitable. So let's make a mathematical example, because sometimes people get confused by this. Let's say I had a $10,000 account, just for the math of this. If I'm practicing 2% VAR, value at risk, that means that the most I should ever have exposed in terms of risk on my $10,000 account on an individual trade is $200, because 2% of 10,000 is 200. That is the maximum risk exposure I should have. You can do less than that, but you should never exceed that. If I place trades of 3-to-1s or higher, where my profit target is 3 times my risk or more, that means I am shooting for trades where the calculated profit target is at least 3 times 200 or $600 or more. It can be more, just not less than that. Let's say you place one trade a day. Typically, there are 20 trading days in a month. And let's say of those 20 trading days, you are wrong 70% of the time. In other words, 7 out of every 10 trades you place are losers. Because you are limiting your risk exposure on those losing trades, you are only losing that maximum risk exposure of $200. So 14 times 200 is negative 2,800. You have lost $2,800 on those 14 losing trades. You're only right 6 times. You're only right 30% of the time. Because you are being selective with your trades and taking trades that have higher profit targets, despite only being right 6 times on those 6 winning trades, you're gaining $600 or more on those 6 winning trades. So 6 times 600 is 3,600. So despite you being wrong 70% of the time, you still have a net profit of $800. This is the foundation of trading at a professional level. We treat all trades equally. The joke I like to tell people is like, all the trades are as if they are your babies. You love them all equally. If you love one of your babies more than the others, that is a concern, right? You should love them all the same. You should treat them all the same. And you should manage your risk and be very disciplined, never over leveraging, never over positioning. If you are too emotional about one specific trade, that should be a concern. You should never be all in on a trade. You should never blow an account on a trade. No one trade should be that significant to you. Now, are you leaving your job with this return? I hope not. I hope you earn more than that with whatever job you may have out there. But the goal with this is it gives you a huge buffer between win rate and profitability. If you are a new trader and you're trying to establish consistency, practicing these very simple risk management protocols really gives you a lot of leeway because it gives you a big buffer between win rate and profitability, right? It's really nice to be able to be wrong 75% of the time and still break even as a new trader. As you start improving your win rate, these numbers start becoming a lot more significant. So let's give another example. Let's say you are a 50-50 trader. What if you are right half the time and wrong half the time? You are as accurate as a coin flip. So let's do the same math. Now we have a $10,000 account. We're placing 20 trades in a month, but on 10 of those trades, 10 are losers and 10 of those trades are winners. Well, 10 times 200 is negative 2,000. 10 times 600 is positive 6,000. So now you're looking at a net profit of $4,000 trading off a $10,000 account where you are never exceeding more than 2% risk exposure on any one single trade. And this is really the foundation of trading. It's not that professional traders don't lose trades. Professional traders do lose trades. But what we do is we are very careful about the trades we take. We are selective about the trades we take. And we make sure that we're taking trades that have low risk with high proportionate profit targets, and that we are never over leveraging, never over positioning, never over risking our trades. Discipline. Trading is all about discipline, risk management, etc. Win rate and money collected means nothing. Ultimately, the only thing that really matters in trading is ROI. How consistent are you? And are you able to pre-produce these results consistently in the market? Small losses and big wins are the reasons we can accept losses more easily psychologically. And this is what you need to wrap your head around if you're going to be a trader. You can't expect to win every trade. What you need to do is manage your risk so that when you lose very little. And when you win, you maximize your profits. If you look at this ratio here, you can see the importance of risk to reward. If you trade 3-to-1s where your profit target is three times your risk or more, your break-even rate is 25%, which means anything above a 25% win rate is profitable. If you take trades where your risk management is 2-to-1s, where your risk to reward ratio is 2 times your risk or more, 2 times your profit target is twice your risk or more, your break-even rate is 33%, which means anything above a 33% win rate is profitable. If you take trades that are 1-to-1s, where your profit is equal to your risk, your break-even rate is now 50%, which means if you want to be profitable, you would have to win over more than half of your trades just to be profitable. This is why risk management is so important to trading. This is why position sizing is so important to trading. I know I'm overemphasizing this, but this is one of the most common mistakes repeated over and over and over and over by retail traders. It's one of the ones where even when you say it to them verbally over and over how important and how critical this is, they will agree with you and then they will ignore it almost instantly. They will break the rules, they will overposition, they will over leverage, they will say stuff like, but this trade looked so good. I couldn't help myself, Mr. Black. And the problem is the market doesn't care how you feel, right? Process and discipline wins over hunches. Trading is systematic. The market doesn't care how you feel about a trade. It's going to do what it's going to do. Another good rule of thumb is to evaluate your progress week to week rather than day to day. A lot of times people get caught up in microcosms, and I try and give an example that people can understand in the real world. Like if I flip a coin and I get heads 5 times in a row, does that mean that coin is going to flip heads forever? No, of course not. You can have little anomalies, right? The same way you might be able to win every trade in a day, you might lose every trade in a day. But see where you are at the end of the week and see if you are progressing week to week rather than day to day, because that way you don't get caught up in little microcosms of anomalies that can happen. One of the other most important aspects of risk management is you can see how critical it becomes if you hold on to losing trades. Professional traders, when we take trades that have low risk and high profit targets so that when we lose, we cut our losses short, and when we win, we let our winners ride. Right? We are maximizing our profit on winning trades. Retail traders do almost the exact opposite of what professional traders do. When retail traders have a trade that is winning, if it's heading towards their profit target and maybe it does a little bit of a pullback, a little bit of a retracement, a lot of retail traders will panic close a trade and they'll be like, oh, let me just lock in something. Oh, thank goodness, at least I locked in some profit. But if they have a losing trade, rather than cut the loss short, they will often let their emotions dictate their decisions, and they will start moving stop losses or even taking stop losses off entirely. And they will hold on to losing trades and essentially cross their fingers, hoping that price action will reverse and come back up in the direction they wish it to go. And this is a big mistake made by retail traders. because the more you hold on to losing trades, the more percent gain you need to recover to get back to where you were. If you lose 20% on a trade of your overall account, you need to gain 25% to get back to where you were. If you lose 80%, you need to gain 400% to get back to where you were. So the math starts becoming really detrimental as people dig themselves into these massive, massive holes, and then they're fighting against the current just trying to get back to where they were. And this is a very discouraging thing psychologically speaking, but it's also the improper way to trade. If a trade ever does come back, you can get back into the trade. You do not need to ride a massive loss down just to cross your fingers and hope that it comes back. Searching on the internet and saying, oh, well, this guy says it's going to be a good investment 5 years from now, that's not the reassurance you need, and it doesn't justify holding on to losing trades. Professionals cut losses short. We manage our risk accordingly. We limit our risk exposure, and then we maximize our profits by riding those longs, by riding those winning trades to the further profit target. Finally, we have trade management. When we are identifying trades, we are looking for trades that are high probability trades, of course, and that have good reward to risk ratios. But that being said, even though we are always looking for trades that have high proportion of profit targets, we are going to manage these trades along the way as they head towards the further target and take profit along the way. This is called trade management. Now, there are different ways in which you can manage a trade. You can manage a trade more passively or more proactively. You can scale in and scale out if you want to be a little more proactive out of it. Or you can just take profit at certain targets and adjust your stop losses accordingly. So let's talk about a more basic form of risk management. Let's say I was taking this short position, my yellow circle being the entry here on this short position. So shorting is making money as the market goes down. So you enter first with a sell, and then you buy later at the lower price to cover. In this area, you can see that I've divided our overall profit into three separate sections: a TP1, take profit 1, a TP2, a take profit 2, and a TP3, a take profit 3 for our final profit target. And if I were to manage this trade, what I could do is, once I'm in the trade, if I hit that TP1, I could shave off some of my position, lock in some of that profit, and then move my remaining position stop losses to break even. So now I'm in a position of comfort. Now I've set myself up where no matter what, I've locked in profit on the trade. Worst case scenario, if my remaining open positions come back in, they're going to close at break even, and I'll have locked in profit on the portion of my trade that I closed. Once I hit TP2, once again, I can shave off some more, close some more of my position, lock in more profit, and now I can move my stop losses up to TP1. So now my remaining open positions, even if they reverse back against me, will actually close in profit because my stop loss is now in profit. And then finally, as I hit my TP3, close the position entirely. This is more passive trade management. You can set this up ahead of time, and you can just adjust your stop losses after you hit these targets. But this helps new traders maintain discipline as they wait to hit further targets, because a lot of times people will get very nervous in open positions. So being able to lock in that profit along the way usually helps people maintain their discipline as they go and seek these further profit targets. That is it for today's lesson. In lesson 4, we're going to talk about a bunch of stuff. What type of trader do you want to be? The mindset of a trader, trading for income versus investing, the pitfalls of just basic buy and hold mentality, and we'll talk about proper diversification. But that is it for today. Thank you, everyone. Have a great day.